Imagine waking up tomorrow, grabbing your coffee and seeing the headlines flash. Oil prices triple overnight, gold surging to new highs, and global markets in freefall. Sound dramatic, right? But history tells us it isn't just possible, it's happened before. As a trader, how should you be trading World War III? In this video, I'm going to deep dive into exactly what you should be looking for, how you should be trading each and every asset class, be it index futures, gold, oil, currencies, and also how the Federal Reserve has historically acted during times of wars, be it World War II, the Korean War, 9/11, the Iraq War. The reason I'm doing this video is yesterday, the 21st of June 2025, the US bombed Iran's nuclear facilities. Now, as you know, Iran has various allies, namely Russia, China, Yemen, North Korea, the list goes on. On the other side, the US is allied very strongly with the NATO countries. United Kingdom, France, Germany, everything is lined up for World War III. I have written an extensive research paper, which I'm going to share with you right now. I'm going to cover exactly what has happened in the past, what you need to look for, and at the end of the podcast, I'm going to tell you exactly what your bias should be for each and every asset and how to be mindful that you're going to have extreme rebounds also. So should you be selling the rumor, buying the news, everything will be covered shortly.
Welcome to the deep dive. We're here to cut through the noise and get straight to the insights you need. And right now, the global stage, it feels incredibly volatile, doesn't it?
It really does.
We're seeing things like the July 21st U.S. bombing of Iran's nuclear facilities. And that's all happening against this backdrop of, well, rising tensions across the Middle East, plus the ongoing Russia-Ukraine war.
Yeah, it's a lot happening at once.
Exactly. And these aren't just headlines, right? They create huge uncertainty in the markets and really for all of us. So our mission today is to give you a shortcut, a way to be well-informed without getting totally overwhelmed. We've taken a pretty comprehensive report, really distilled it down, and we're ready to share the key takeaways and maybe some surprising facts too. Our focus for this deep dive is U.S. wartime monetary policy and market reactions, historical insights and current risks. It's a really critical look at how conflict impacts finance, and honestly, it couldn't be more relevant to what we're seeing unfold right now.
Absolutely timely.
And this deep dive, it draws from a really insightful report by a professional trader named Cam. Now, Cam's background is quite unique. He blends AI expertise from a computer science degree with a finance-focused MBA.
Right, that's an interesting mix.
Yeah, and he's got real-world experience, too. Worked on the trading floor at Goldman Sachs during the great financial crisis.
Wow, trial by fire there.
You could say that. And then innovating with cutting-edge AI at JP Morgan. So he brings this perspective that bridges, mainstream trading ideas with how institutional algorithms actually work.
So he really understands the plumbing of the markets during stress.
Exactly. That's the idea. So today we're going to explore how the U.S. Federal Reserve historically behaves during wartime. We'll look at how key assets, stocks, gold, oil, currencies reacted in past conflicts. Then we'll assess the implications of the current escalations. And finally offer a forward look with some, crucial considerations for you if you're navigating these markets.
Sounds like a plan.
Okay, so to really get a handle on today's volatile markets, we kind of need to look back first, right? When the U.S. has been involved in major conflicts historically, what's the Fed's playbook? How have they typically responded?
Well, what's fascinating and pretty consistent, actually, is that the Fed has almost always leaned towards being accommodative during major wars. Yeah. The goal is generally pretty clear. Support government financing, keep the economy stable. You can almost think of the Fed becoming this sort of supportive engine for the war effort itself.
A supportive engine, okay.
Yeah. So take World War II, for instance. The Fed explicitly pegged interest rates really low, very low. And they bought huge amounts of bonds to help the Treasury pay for the massive war effort. Back then, wartime needs clearly took priority over worrying about inflation. That only really changed with the 1951 Fed Treasury Accord. That was pivotal.
Oh, the Accord.
Right, exactly. That restored the Fed's independence. But before that, and even during the Korean War, you saw a similar dynamic. The Treasury had a lot of influence, keeping rates low until the Accord finally let the Fed start tightening things up.
So it really sounds like the Fed was Well, almost taking orders from the Treasury for a while there, prioritizing the war machine above maybe price stability. Is that fair?
That's a very fair assessment. The historical record is pretty clear on that. And that pattern, it continued, though maybe with slightly different flavors. Think about the Vietnam War era, the 60s and 70s. The Fed faced just intense political pressure to accommodate huge government spending, funding both the war and President Johnson's Great Society program.
Right, the guns and butter issue.
Exactly. And the report highlights this key insight. Vietnam War spending helped trigger the great inflation of the 1970s. Why? Because the Fed initially kept policy too loose for too long. It really illustrates this trade-off almost embedded in their history. Easy money during the war, even if it means dealing with higher inflation down the road.
So they kick the can down the road on inflation sometimes.
In essence, yes. It took Chairman Volcker much later in the late 70s to really aggressively hike rates and finally break the back of that inflation.
That's a critical point. It does make you wonder, doesn't it? If a major conflict blew up today, would they face those same really tough choices again?
It absolutely raises that question. And we've seen echoes of this pattern in more recent conflicts too, After 9/11, leading into the Afghanistan war, the Fed moved incredibly fast. Massive liquidity injections, slashing the federal funds rate by 3 percentage points, just boom, boom, boom.
Trying to cushion the blow.
Precisely. To stabilize markets, offset that huge shock to confidence. And during the first Gulf War in 90-91, which was shorter, the Fed also eased policy as the conflict and the oil spike helped tip the U.S. into recession. Even leading up to the 2003 Iraq War, the Fed kept rates at historic lows, around 1%. The priority was growth and stability amid all that geopolitical uncertainty.
So the pattern holds up even in more modern times.
It does. The core takeaway here is, when the U.S. is at war or facing a major geopolitical shock, the Fed has consistently leaned towards rate cuts or other accommodative measures. Calm the markets, support the economy. This wartime monetary posture, as the report calls it, it's been seen again and again. It really underscores the Fed's role in, backstopping the economy during these national security crises. Tightening usually only comes later if inflation becomes a really serious problem.
Okay, that gives us a really clear picture of the Fed's historical reaction function. So with that context, the next big question is, how do the markets actually react? Stocks, gold, oil. What happens when conflicts ignite?
Right. This is where it gets really interesting for traders. Generally, you see this initial risk-off move, a flight to safety, in the lead up to war and right when it starts. But then often you can get these relief rallies. Equity markets, for example, they just hate war uncertainty, so they tend to sell off first.
Like after 9/11.
Exactly. Post 9/11, once markets reopened, that was the immediate gut punch, right? The Dow plunged 14% in just a week. The S&P 500 fell about 11.6%. It was a stark picture of that initial panic. Similarly, in early 2003, remember the buildup to the Iraq invasion? The S&P 500 was really languishing, weighed down by those geopolitical fears.
But I do seem to recall reading, maybe in the report, that markets sometimes rally once the fighting actually starts. Is that a real pattern, like a sell the rumor, buy the news kind of thing?
It often is, yeah.
Yeah.
Markets frequently rebound once the shooting starts, and some of that intense uncertainty begins to resolve. Look at the U.S. invasion of Iraq in March 2003. There was a noticeable relief rally. The Dow jumped almost 1,000 points. That's about 12% in just 8 sessions once the war began. And it looked like, things were progressing quickly.
Well, so clarity helps, even if the news isn't necessarily good.
Precisely. A Reuters analysis mentioned in the report looked at past Middle East conflicts and found the S&P 500 was actually 2.3% higher on average 2 months after a conflict started, despite that initial dip. It really illustrates that markets seem to hate uncertainty more than bad news. Volatility spikes during the initial invasion phase, for sure, but markets can bounce back if the absolute worst-case fears don't materialize.
Okay, so stocks get hit by uncertainty but can recover. What about gold, the classic safe haven? Does it reliably shine when things get tense?
Oh, absolutely. Gold is kind of the quintessential hedge in a geopolitical crisis. It's almost always boosted by wartime fear. Leading up to the Iraq War, say from 2002 into early 2003, gold jumped around 17%, went from under $300 an ounce to $350. That was driven by what the report calls high anxiety.
And 9/11.
Even more dramatic.
Right.
After 9/11, gold spiked violently, a 33% jump for about $215 to $287 an ounce. That really reflected nervous investors' uncertainty and flight to safety.
But does that gold spike last, or does it tend to fade if the conflict is, I say, contained or ends quickly?
It can definitely fade. If the worst fears are avoided, or if a conflict resolves faster than expected, that war premium in gold can evaporate pretty quickly. We saw that after 9/11, gold did retreat. And similarly, after Baghdad fell relatively quickly in 2003, gold's rally stalled out. However, if you get prolonged instability, like we saw through much of the 2000s, that can keep gold on an upward trend, often helped along by a weaker dollar and maybe inflation worries linked to war deficits. So yeah, current escalations, very likely to send gold higher, at least initially.
Makes sense. Now let's talk oil. That feels like the big one, especially with anything involving the Middle East. Every time tensions flare there, oil prices seem to dominate the headlines.
Yeah, oil's impact is definitely outsized, simply because the Middle East is such a critical global supplier. Think back to early 2003, before the Iraq invasion. Crude oil prices shot up almost 75%, went from around $20 a barrel to $37, purely driven by war fears. We saw a brief spike post 9/11 too. But the critical risk, and this is incredibly relevant right now, is the Strait of Hormuz.
That narrow waterway.
Exactly. It's incredibly narrow, and something like 20% of the world's entire oil supply flows through it every day. And Iran has repeatedly threatened to close it in the past.
And if they did?
Well, if Iran were to actually close the strait or even just significantly harass shipping there, it could effectively choke off a significant portion of global oil supply. The report suggests they could send oil well into triple-digit prices, maybe seeing $100 oil very quickly. So wars involving the Middle East reliably bring oil volatility and price spikes. And that, of course, feeds directly into broader inflation, which then affects bond markets, currency markets, everything.
Okay, oil is key. What about currencies then? The US dollar usually strengthens in these situations, right?
Yeah.
As a safe haven.
That's generally the pattern, yes. In wartime, currency markets typically see that flight to safety. And the US dollar, being the world's main reserve currency, often benefits. We saw this just recently, in June 2025, with those US-Iran jitters we mentioned. The dollar rose pretty broadly on that safe haven demand. Meanwhile, currencies like the euro, the Australian dollar, the New Zealand dollar, they dropped.
And historically,
History supports that. The US dollar, the Swiss franc, sometimes the Japanese yen, they tend to strengthen. Currencies tied more to global growth or emerging markets tend to weaken. Now, there's a nuance. A very long, costly war that really damages the U.S. economy, like Vietnam perhaps, could eventually raise questions about the dollar. But in the immediate term, the report emphasizes the dollar's status as a liquid, safe asset usually wins out. Analysts typically expect the dollar to initially get a safety bid. That often goes hand in hand with lower treasury yield as money flows into bonds and a stronger dollar. We saw that in early 2003 as well. So yeah, expect the USD to strengthen early on.
Okay, so we've covered the Fed playbook, the typical market reactions. But this brings us to a really critical point. The report, it doesn't shy away from looking at some pretty extreme, previously almost unthinkable scenarios like World War III. Given the current situation, the U.S. strikes on Iran, the ongoing conflicts in Israel and Ukraine, what are the potential triggers? What could actually escalate things that far?
Yeah. This is the sobering part. The current confluence of geopolitical crises is genuinely concerning, and there are several potential triggers that could ignite a much wider conflict. First, there's the risk of a direct U.S.-Iran clash escalating uncontrollably. That July 21st U.S. bombing of Iran's nuclear sites was a major escalation, and importantly, Iran's allies, Russia, China, they've signaled support. Putin has explicitly warned about growing global conflict risks, specifically mentioning the Middle East.
So what's the specific trigger there? Iranian retaliation.
That's the key risk. Iran striking back directly at U.S. forces in the region, or U.S. allies like the Gulf states, or maybe unleashing its proxy militias in Iraq, Syria, Lebanon. Iran has already threatened everlasting consequences, according to reports. That kind of retaliation could easily lead to larger U.S. responses, and you could see a spiral drawing in NATO, supporting the U.S. or Israel, versus a Russia-China-backed Iran.
And the Strait of Hormuz, which you mentioned with oil, that could be a military flashpoint too, not just economic.
Absolutely. That threat by Iran to close the strait, remember, 20% of world oil wouldn't just be economically catastrophic. It would almost certainly compel the U.S. and its allies to intervene militarily to force shipping lanes open. That intervention could put U.S. and NATO naval forces directly in confrontation with Iranian forces. And imagine the risk. A stray missile, a mishap involving a Russian or Chinese commercial ship in that chaos. That could give those powers a pretext to step in, risking a really rapid escalation between nuclear-armed states.
A miscalculation away from disaster.
Potentially, yes. Then you have the factor of direct Russian and Chinese involvement. Putin explicitly links the Iran-Israel conflict to Ukraine, framing it all as the U.S. orchestrating proxy wars. A specific Russian tripwire, as a report puts it, could be harm coming to Russian personnel in Iran, maybe contractors helping with air defenses or nuclear sites. Or if Iran were to request Russian peacekeepers or more advanced weaponry, that could bring Russia and the U.S. much closer to direct confrontation.
And China's role.
China has huge interests in Gulf oil and a growing partnership with Iran. They could step up support for Tehran weapons, economic lifelines, creating more friction with the U.S., and the really nightmare scenario. If the U.S. gets bogged down militarily in the Middle East, China might see an opportunity to test U.S. resolve elsewhere, maybe over Taiwan or the South China Sea. Suddenly you have a second major front. That confluence of simultaneous conflicts, the report warns, could effectively spill into a world war.
It's chilling to think about these different theaters potentially merging. What about the Israel-Iran conflict itself? How does that specific dynamic add to the risk?
That's another critical flashpoint, yeah. It's already an unconventional conflict. But imagine if Iran launched a major direct ballistic missile attack on Israel or pushed Hezbollah to open a massive second front from Lebanon, making Israel feel its actual survival was at stake.
The U.S. would likely get involved more directly then.
It seems highly likely the U.S. and maybe NATO allies would intervene more openly to defend Israel in that scenario. And then there's the nuclear dimension. There's always speculation that Israel, facing what it perceives as an existential threat, might resort to its undeclared nuclear arsenal. Even a tactical nuclear use would trigger the absolute highest level of global crisis imaginable. And even short of that, just sustained missile exchanges across the region dramatically increase the chance of a misfire into nearby countries, hitting a Gulf state, maybe a U.S. base, and dragging them directly into the war.
So putting it all together,
if you connect the dots, the path to a World War III scenario could be a kind of chain reaction, as the report describes it. A U.S.-Iran war that spirals, drawing in Russia and China against the U.S. and its allies, potentially merging with a NATO-Russia clash stemming from Ukraine. Putin's rhetoric, Russia's recent military cooperation moves. It suggests the major powers are actively posturing. A single mistake or overreach by any side could ignite a much wider war frighteningly quickly. 2025 feels like a powder keg with these multiple flashpoints: Ukraine, Israel, Iran, Taiwan, each carrying this devastating world war risk if they ignite together or pull in the nuclear powers.
Okay, wow. That is a lot to process and deeply concerning. So let's bring this back to our listeners, especially those navigating the financial markets. What does this all mean for you? How do you prepare for such potentially massive shifts?
Right. I mean, a full-blown World War III scenario would be a true Black Swan event with almost unimaginable consequences. But even the current level of tension, the risk of escalation, is a major driver of volatility right now. So for traders, the report suggests focusing on a few key areas. First, obviously, energy markets and ways to hedge inflation. The Strait of Hormuz and oil infrastructure are basically ground zero. Any credible threat there, let alone an actual closure, could cause oil prices to spike violently, potentially far above recent highs. Brent crude going well into triple digits seems plausible in that scenario.
Which feeds inflation.
Exactly. It creates a nasty stagflationary shock, spiking inflation, combined with a hit to economic growth. And think about what that does to central banks. Central banks like the Fed might be currently thinking about rate cuts, but a huge oil spike driving inflation up. Suddenly they might have to contemplate delaying easing or even hiking rates again. It definitely lessens the chance of near-term rate cuts.
So how do you hedge that?
Well, having some portfolio exposure to oil itself or energy stocks can act as a direct hedge. And gold, as we discussed, is the classic geopolitical hedge.
Okay, energy and gold. What about the broader risk-off move? Where does money flow then?
You'd expect that classic flight to quality we talked about. Strong demand for U.S. treasuries, the U.S. dollar, the Japanese yen, the Swiss franc, and gold. Remember June 2025? Those war jitters saw global stocks tumble while the USD and the Swiss franc strengthened noticeably.
So, practical steps.
For your portfolio, consider moderating or actively hedging your exposure to risk assets, things like stocks, especially high-growth tech, high-yield credit, emerging market assets. You can use equity index futures like going short the S&P 500 as a hedge. Volatility products, VIX futures or options can also help hedge against that tail risk, those extreme market moves.
And treasuries.
A big rush into U.S. treasuries would almost certainly push yields down, meaning prices go up, at least in the short term, as investors seek safety. The yield curve could do funny things. Maybe steepen if there's an oil shock, or maybe all yields fall if the panic is extreme enough.
And keep a close eye on the Fed. presumably.
Absolutely critical. Watch the central banks, especially the Fed. Their statements will be key. Will they prioritize fighting inflation driven by oil? Or will they pivot back to supporting growth and market stability, like they did post 9/11, with emergency easing and liquidity? Their communication, their tone will be vital clues.
What about currency markets specifically? Any key things to watch?
Yeah, for FX traders, keep an eye on the US dollar index. A major risk-off event could trigger an upside breakout due to that safe haven demand. Near-term strength seems likely. The Japanese yen and Swiss franc could also strengthen significantly. On the flip side, emerging market currencies and currencies of major oil importing nations could slide. Commodity currencies like the Canadian or Australian dollars might initially fall with risk assets, although Canada's dollar could find some support later if oil prices stay very high. And practically, use wider stop losses. Be prepared for liquidity to potentially dry up in certain pairs during peak stress. Manage your leverage carefully.
And within the stock market itself, are there specific sectors that tend to do better or worse in wartime?
Yes, there are typical winners and losers. Defense contractors, military technology companies, and as we said, energy stocks often climb. Industries like airlines, travel, leisure, they usually suffer badly. Certain tech stocks can be vulnerable too. Just think how devastated airlines were after 9/11.
So watch those sector rotations.
Definitely. Monitor the main index futures, like the S&P 500. But remember that historical tendency for markets to sometimes over-discount worst-case scenarios and then rebound if those don't play out. Okay. Also consider geographic hedging. For example, if Europe is likely to be hit harder by energy price shocks than the US, you might adjust your relative exposure between European and US stocks.
Okay, one last crucial point from the report, the role of news headlines. It feels like markets could just gap wildly on a single news alert.
That's exactly right. The report stresses that headline risk is paramount. Markets could move violently, gaping up or down, on breaking news about missile strikes, Hormuz incidents, major power responses, anything.
So stay glued to the news feeds.
Absolutely. Reliable, fast news feeds, Reuters, Bloomberg are essential. Maybe even set up alerts for key phrases like Hormuz, missile strike, nuclear, NATO response. The advice is generally to keep trading positions nimble, don't get overextended, and be very aware of weekend risk. Geopolitical events often unfold when markets are closed, leading to potentially huge gaps when they reopen on Monday or Sunday night for futures. Options can be one tool to help manage that gap risk.
Wow, what an incredibly detailed and sobering deep dive. We've covered so much ground, from the Fed's predictable yet sometimes surprising wartime playbook to the typical market risk-off reaction, that potential for recovery, and crucially, the really unprecedented nature of the current geopolitical risks, especially that potential for a devastating chain reaction.
Yeah, I think the report paints a stark picture. The world and the markets in 2025 really do seem to be walking on its edge. And the difference between, say, a contained regional conflict and a spiral into something much bigger, potentially a world war, well, that means profoundly different outcomes for markets and for all of us.
A powerful thought to end on. Being prepared, or at least considering the possibilities for either case, seems like the mark of a prudent trader and an informed citizen right now. Thank you so much for joining us on this deep dive. Stay vigilant, stay informed, and please manage your risks wisely out there.